Richard, I'm trying to
Morning.
understand whether all of this is a net positive or a net negative, just in terms of how that sets us up for the remainder of the year.
Well, I think what it's indicative of straight away is that at the moment it's a stock picker's market, i.e. certain parts of the technology industry are going to do a lot better than others. And I think you can see that already. If you look at Microsoft's numbers, good set of numbers. The enterprise was strong, but consumer was incredibly weak. If you look at IBM, predominantly an enterprise company, good set of numbers. If you look at Tesla, very special case, because don't forget, Tesla only plays in the electrical vehicle market, which will show growth this year compared to the rest of the auto market, which may actually be considerably weaker. So you have to pick and choose exactly where you want to look. And I think that's going to be the theme for this year.
How problematic is it that a lot of big tech has bet on the rise of cloud software, and now cloud is arguably going to run into some trouble? That's gonna come back to bite in the results later on the year, isn't it?
Yeah, the problem is now, I think cloud running into trouble is not quite how I'd put it. I mean, what they've basically said is cloud was growing at 40%, now it's going to grow at 30%. In this environment, growing at 30%, I would argue, is probably the best growth in the technology industry at the moment. However, the problem is that companies, particularly Amazon, have been using the profits generated by cloud to subsidize investments in growth in other parts of the business. Now, if cloud starts to slow down its growth, that means there's less money for this subsidization. And this is why I suspect Amazon is cutting so hard. And you saw a similar thing at Microsoft. Microsoft's consumer business is its most profitable by a very long margin. That has been incredibly weak. And now it's having to cut because margins are under pressure due to the way that the mix is coming through.
Richard, do you think that the worst is behind us in terms of the job cuts? Are we just getting started here for big tech?
Again, I think it depends on a case-by-case basis. Now, when I look at social media, if I look at Snapchat, if I look at Meta platforms, I would argue they're still massively overstaffed. If I look at other companies, such as Apple, if I look at Microsoft, for example, the degree to which they've bulked up, I think, is much less of a degree. And I think even some of these companies are making sort of cosmetic cuts, if you like, in order just to be seen to be making cuts, because that's what the shareholders want to see in this more austere environment. So in terms of the worst is over, I think the place to look is going to be social media for a lot more cuts to come.
What about the other earnings that are still to come? Intel later in the day. I know you're looking at some other large industry players. I mean, what in particular is something investors need to eye here?
I think the other thing to look out for in the sector is going to be relative performance compared to value. So, Tesla put out a good performance, but I would argue that the shares have not been in touch with reality for some considerable amount of time. Flip side of that is, company like Qualcomm. Qualcomm is doing particularly well if you think about its long-term prospects. In the short term, it's suffering because of an inventory correction. But again, this is a company where the valuation is very much in touch with reality. Intel's kind of in the middle. Intel's going to be an interesting one because Intel is in the midst of this transition. It's a make or break transition. And there are significant doubters out there who think that Pat is not going to be able to turn this company around, and it could be the end of Intel. So that's going to be a very interesting one to watch.